Welcome to today's session. Today we will be dealing with working capital management and a question relating to it. So, the question given is regarding the capital ratios, and there is a statement of financial position given for 2 years, that is 2017 2016. All the details are given, and there is a question saying calculate the liquidity ratio for both the years, and also the length of cash operating cycle for 2006 2007, and the third is they are asking you the explanation with the ratios calculated. So the first question asks you to calculate liquidity ratio. So for calculating liquidity ratio, current ratio and quick ratio should be calculated. Formula for current ratio is current assets divided by current liabilities. So current assets are inventories, receivables and bank. So we have to add all this and divide it by current liabilities, that is trade payables. So for 2006 we get the total as 65 divided by 65. So when we simplify, it becomes 1:1. And for 2007 it is 74 divided by 46, that is 1.6:1. So this is how you calculate current ratio. Next we'll be calculating quick ratio, and here quick ratio, when we will not include inventories while calculating. Okay, so the current assets will be excluding inventory, that is current assets minus inventory divided by current liability. So here under 2006, 65 will be the total of current asset, and we will deduct 37. So you can see that we have highlighted in pink color those are the assets that will be included, and current liabilities will be 65 itself. So we will get 28 divided by 65, that is when we simplify we get 0.43:1. Similarly for 2007 also you can do it in the same way, and for current assets either you can add 29 plus 3 to get the total of current assets. We don't add inventories. Or another way is that you can deduct 42 from 74. Either of the ways you can calculate the current assets, that is current assets minus inventory is the formula used in while calculating quick ratio. So while current liabilities will be the same 46, so you'll get 0.7:1. And below I have written one explanation. It is the answer actually for the C part of the question. Then we'll be calculating the second part of the second part, that is cash operating cycle for both the years, and the formula to calculate it is inventory days plus receivable days minus payable days. Inventory days, which is also called inventory holding period, is calculated average inventory divided by cost of sales into 365 days. So we have to first calculate average inventory, which is opening inventory plus closing inventory divided by 2. So the opening inventory, you can see in the question, is highlighted in blue color and closing inventory in green color. So you have to add both and divide it by 2 in order to get average inventory for both the years. Then you have to calculate cost of sales, because average inventory is divided by cost of sales and then multiplied into 365 days. So cost of sales is calculated opening inventory plus purchases minus closing inventory. So in the question, opening inventory for 2006 is 29, purchases is 159. You add both, you get total as 188, and subtract closing inventory, that is 37, and you get the total, that is cost of sales, as 151. It is circled in red, right? You can see that. So in the working, we have seen that 39.5 divided by 157 into 365, we get 92 days for 2007, and for 2006 we get 80 days. So the inventory holding period have increased or extended. Similarly, we'll be doing receivable days, that is receivables divided by credit sales into 365 days. So here the receivables are just closing receivables, so we will not take the formula that is actually found in your text, that is average receivables divided by credit sales into 365. That is in case opening and closing receivables are given. So in the question you can see receivables is highlighted in pink in the statement of financial position, while this in the statement of profit and loss you will find sales or sales revenue, that is highlighted in green. So you have to divide both the figures according to each year and then multiply it with 365 and you'll get for 2006 it is 43 days and for 2007 51 days. So thus receivable days has also increased. So next we have to calculate payables days, that is payables divided by credit purchases into 365 days. So payable figures you will find in statement of financial position, and purchases figures you will find in statement of profit and loss. So both the figures you will divide. For 2006 55 divided by 159 into 365 you'll get 126 days, and for 2007 the final answer will be 81 days. So we find that the payable days have decreased. So we have found all the three. Now we will calculate, that is inventory days minus payable days plus receivable days. You'll get length of cash operating cycle. For 2006 it is -3. That is an unusual situation. That means you receive the cash 3 days prior to the payment for the supplier, and for 2007 you get 62 days. That is unusual.